Okay, general question here, and this could be related to covered calls, collar spreads, credit spreads even, but I've got something I want to add on that. But let's just say naked puts, covered calls, collar spreads, anything along those lines. Fernando says, usually I close the sold option if the gain is over 70%. So I sold a covered call for $1. As we got closer to expiration, it's either out of the money or slightly in the money, and I can buy it back for 30 cents. I've made 70% of what I expected. What Fernando wants to know is, do you think this is a good rule, or is it better to wait for the expiration date? Basic thoughts on that. Yeah, I'll just go back to the custom spread tool without anything on it for right now. Basic thoughts, Fernando, on that is, number one, Ernie and I are high advocates of going with the 80% rule, not 70%, okay? So if I am in a naked put position, I sold a cash secured put, and I'm 10 days away from expiration, I can buy it back and receive 80% of what I expected to make, I might take it off the table. We use 80. Not to say that's better than what you're doing. Number two, what you should be doing, Fernando, and I'm sure you already have because you and I have had these discussions, you're using a 70% rule. First question, is it working out for you to where you're still meeting your target goals for that strategy in your portfolio? Number two, go back. And you can probably see this on your broker maybe or other positions. Go back and see how many times over the last 4 months, 5 months, how many times over the last 4 months, 5 months, did the options you closed at 70% of your expected profit reach the full 100% of expected profit on expiration versus how many of those fell and ended up with less of a return or maybe even a loss? Run that comparison. Are you helping yourself or are you hurting yourself by doing this? Why is that important? Okay, so we did a little discussion on credit spreads. We pulled up the bull put weeklies, which many of you have heard that I use as my search for what I look for to open maybe 3 to 4 positions each cycle that are 2 weeks out in time, and I'm looking for a minimum probability of 85%. And to match my targets, what I'm look to do is, and I'm here, yeah, I'm here, I look to have an average of a 15.1% on my winners, and one of my triggers, which you'll see in that webinar, is if the position, the stock moves against me and the position's at around a 40 or 50% loss of the max expected, I'll look to adjust or just close the position and move on. That looks dangerous, doesn't it? Win ratio of 15.1%, taking a loss of 50%. Well, because I have the proper structure set up, let me show you something else. Okay, and we'll just go to radioactivetrading.com. You're not seeing my screen, I know. Be there 1 second. Click the wrong thing. Okay. Excuse me, folks. All right. So I'm going to the Resources tab on radioactivetrading.com, and I want to use the Trade Simulator. Why is that? Because I want to show that if I make average 15.1% when I'm right and lose on average 48.9% when I'm wrong, and that's too much. I put in a 15%. Oh, shoot, that's why. Okay. There we go. 33%, third invested in each trade. Give me a second here. Okay, there's almost close, pretty close. All right, I'll just use this. If I'm right 82 or 83% of the time, I'm meeting my goals. Okay. There is the possibility for a large drawdown, 20, 25%. We talked about that before. But if I'm able to achieve these goals with an 83, 84% success rate, I'm sorry, if I'm able to hit these targets, then I'm successful. 87, I'm really successful. The sweet spot's around 83 and 84. I saw an 84, I'm trying to, there we go, 83. Okay. But sometimes you can see a 40, 50% drawdown. That has happened to me, as I mentioned, honestly. But again, over time, proper win ratio, proper probability, and proper goal targets, you could still be extremely successful over time with credit spreads, even though you might take a high drawdown. I understand. This chases a lot of people away. There's ways to help that too. Other than the management, there's ways to hedge against that. Why am I showing this? A popular theory out there right now, by the way, I'm not just pulling this out of the ether. This is my targets and my average gain on winners, loss on losers, and average win ratio, actually a little bit higher than 83, it's probably around 86. In any case, of bull put credit spreads for the last 4 years. And there are times when I don't trade, when I see the market turn, and there's certain criteria met. But in any case, a popular theory out there for trading credit spreads is that if you reach 50% of your expected profit, go ahead and close the position. The concept, of course, is obvious, that if I close these winners, when I get to a 50% return, then I'm going to have less losers. This probability of loss is going to drop down to maybe 7%. So I'm going to be at a 93% success rate and a 7% loss rate. So I increase the winners by closing early and don't take as much losers. 4.5, 5 years of trading these bull put credit spreads and testing bear calls and trading bear calls has shown me one thing that is concrete in my mind, that I am hitting my goals in this case 90% of the time. The 17% of these trades that are losers within the first 4 to 5 days. And when you open a bull put credit spread, just like any option strategy, you're down to begin with, just based on the bid-ask spread. I can't liquidate the minute I open a bull put credit spread and take a profit. I need 1 or 2 days of time decay to see any profit. And there's the problem. With 1 week out, 2 week out spreads, the 17% of the time you lose, you're still losing because the stock starts to go against you in those first 2 to 3 days, 4 or 5 days, 6 days. It never hit the 50% profit. So what are you doing by taking a 50% profit? You're dropping this. You're dropping the 83% of the time you would have won 100% and hit your 15% target. You're dropping it down to 7.5. Well, probably closer to 7.5 or 8%. And these 95% of those, 90% of those that you lost on, you're still losing, and you're still losing at an average of 48.9%. You don't increase the win ratio. 4.5 years, 3 to 4 trades every 2 weeks. The ones that lose still lose. Closing at 50% does not give me a better win ratio. All it does is lower my target gain. And what does that mean? Can I be profitable long term, making 8% when I'm right, averaging 48.9% when I'm wrong, being right 85% of the time? Long term, no. Start with $10,000, allocate 33%, a third to each trade, 87% win ratio, I'm down 3%, 2%. I didn't increase the win ratio because those losers were still losers. Naturally, if you're only right 84% of the time, where I'm actually profitable with what I'm doing now, with holding it more to expiration and not trying to close early, you're at a 50% loss. I don't agree with this idea of closing the credit spreads early for a 50% gain because I haven't seen it increase the win ratio. The ones you lose, you still lose on, and then you cut your gains in half. You cut your legs out from under you, so you're not meeting your goals. In fact, you're setting yourself up for a high loss. But I just wanted to bring that up in relation to the credit spread trading. Fernando, there's nothing wrong with using a 70% closing price on your covered calls. Your collars, your dynamic collars, the calendar collars where you have a further out put on your stock and you have a shorter term call, you close it when it's 70% profit to you. Cash secured naked puts, there's nothing wrong with that. I would go back and look at the numbers. Your last trades, excuse me, or the last 4 or 5 months where you did close out for the 70% profit, and see, would you have gotten 100% on more of them? Maybe increase that to 80%, 90% or so. Probably 80% would be a good one to use. 80-20 rules, where that comes from, the 80%. Of course, if you look at it and you see that, you know what, of those positions in the last 4 or 5 months you closed when you had 70% expected profit, if 55 or 60% of those ended up being a loss and only 40% or 30% ended up going to the full gain, then you're doing it right. Okay? So, and you said when you apply income method number 1, that's what I mean by the dynamic collar. Okay, that's what I mean by the dynamic collar. When I say dynamic collar, I mean that the put is further out in time than the short-term call. I just didn't say it in the terminology of income method number 1 because it applies to anyone who's using any type of collar, covered call, cash secured naked put, Income method number 1 in the radioactive trade. When you've reached 70% of your expected profit, close it. Look back at your numbers, Fernando. Run that example and see if you're hurting yourself. And I can guarantee you're likely not hurting yourself as bad as the example I just showed with credit spreads, where if you close at 50% profit, my experience has been you're not increasing your winners, you're just cutting out your returns, and now you're not achieving your goals. It's not a good idea, I feel, personally. And that's been my experience last 4.5 years. But you're probably still doing okay with what you've been doing with the 70% profit. Ernie and I just use 80, the 80-20 rule. We've used that for as long as I can remember since I started working. Of course, because Ernie's my mentor, so I learned from him. But we go by that 80-20 rule. If you reach 80% of your expected premium on a covered call, collar position, income method number 1 in a married put, which is just a dynamic collar that you created later, even a calendar spread, a diagonal calendar spread for that short option that's near term. If you reached 80% on that, that's when I might look to buy to close it. Cash secured naked puts as well. I just don't do that on the credit spreads because I want to achieve the full profit to keep my target returns in place, and it still manages to keep my win-loss ratio in place as well. All right. Well, ladies and gentlemen, we're at 5:37 p.m. Eastern Time. I don't see any other new questions that have come in. I'm just going to go through and check that. Yeah, there's no other questions in the question pod there. If you have any last-minute questions, go ahead and send them in. But I just want to remind everyone that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. I'm not going to open a bull put credit spread on semiconductors. On Monday, I might not open a bull put credit spread on TEAM, which came up on that bull put weekly list, which is the list I use to select my bull put credit spreads. If I still see a sell warning on the market sentiment tool, I might not open bull put credit spreads this cycle. So I'm not giving direct advice, just ideas and concepts of how one might look to manage, structure, and the importance of position sizing in any strategy, especially trading leverage long calls and bull put credit spreads and things along those lines. As we know, options involve risk, may not be suitable for all investors, but hey, that's why we're here to try to help you out with ideas to keep you safe, management techniques, hedging ideas, and much, much more. Now, we saw some of the tools today, including the search. We took a little bit look at the portfolio with the position analysis view, rollout opportunities. And of course, if you want to test those out, if you haven't done so already, just go to powerop.com. Put in your name and email address. No credit card billing information is required. You have full access for a 14-day free trial to all the tools on Power Options. After that, our subscription levels start at $45 per month, and then they increase as you go to delayed data, real-time data, if you want access to the full historical data, which goes back about 10 years. All right, now other free stuff. We mentioned the webinars page, gave some guidance. Rick, I think you of course want to check out that webinar there at powerup.com/webinars.asp under the option strategies on managing your long call positions. And Rick and Nick, I believe, you want to check that out for the 8 ways to manage the bull put credit spread, more in depth there as well. There's also other webinars there on the structure and criteria for the different strategies that all of you might find useful if you're looking to expand and try out new strategies coming up into 2020. You can always check us out on YouTube as well. Most of our videos that we host and archive are all public on YouTube as well as on Power Options, just youtube.com/user Power Options. Or just go to YouTube and search Power Options. You'll find it and you'll hear my voice. All right. Well, if you do think of any other questions, ladies and gentlemen, later on, hey, send us an email at any time. You can reach us at support@powerop.com or support@radioactivetrading.com. You can also reach us during market hours at 302-992-7971. And remember, if you're on a current trial or if you're a subscriber, you can schedule one of those coaching sessions at any time. It's a 35 to 45-minute phone conversation with myself or Ernie, answer your questions directly and walk you through the site. Rick says, thanks for taking the time. Hey, Rick, thanks for your question. I really enjoyed the conversation. It was a great question, and I hope it helped you out some way, and I hope that webinar helps you out as well. Chuck says, thanks, and have a great weekend. Hey, you too, Chuck. I'm glad things are looking a little bit better for you there down under after a little bit of rain, but hopefully not too bad with the mudslides and everything else I've been hearing about. Thank you for your comment and your question as well. It's a very interesting concept to see that the credit spreads out of the money with the good probability work well. but they're harder to get into because that wide bid-ask spread with the debit spreads. Even though they're parity trades, it's not a written guarantee that you're going to get close to midpoint. So always good to talk about that and the parity and the difficulties with the parity trades. And David says, thanks for the nice discussion. David, thank you. I hope you enjoyed it. And I thank you for joining us here today. And I thank you all for joining us here today. I hope you all have a fantastic weekend as well. We'll see you soon at one of our next upcoming webinars. Have a great weekend. Happy trading. Good night.